Today, I'm going to tell you something many people don't realize yet. One of the most powerful hedges against a collapse of paper, money credibility isn't gold, it's silver. Why? Because silver combines scarcity, intrinsic value, and explosive upside during monetary crises, and yet it remains vastly underestimated. Let me explain why you should be listening closely. When confidence in money erodes, decisions get made quickly. Investors, institutions, and even central banks don't wait for headlines to validate what their models and instincts are already screaming. They move, and they move fast. In these moments, assets that respond with velocity, not just stability, are critical. Silver, in that context, plays a uniquely vital role that is often overlooked until it's too late. In monetary regimes, there's a rhythm. Periods of trust in fiat money are long and stable, but when that trust is challenged, whether by inflation, excessive debt monetization, geopolitical fracture, or central bank missteps, the shift in psychology happens rapidly. The tipping point usually isn't visible in advance. It builds quietly, then cascades. It's in that transition where silver operates like a pressure valve. Its market structure, supply dynamics, and historical reputation allow it to react far more aggressively and responsively than most realize. The silver market is shallow relative to gold. That shallowness, often perceived as a weakness during calm periods, becomes a strength during volatility. With a relatively small float and a tight supply chain, even modest capital inflows, whether from retail panic or institutional repositioning, can create dramatic price movements. When inflation, adjusted returns are being recalculated across portfolios, silver becomes a lever, amplifying fear, momentum, and protection, seeking behavior all at once. What this means practically is that silver doesn't just preserve purchasing power, it multiplies it during monetary dislocations. It's important to understand why this happens. Silver, unlike gold, has significant industrial utility. That demand doesn't go away in a monetary crisis. It may even increase as governments scramble to subsidize infrastructure, energy transitions, or digital economies to retain legitimacy. So you have a rare case of a monetary metal whose baseline demand isn't just emotional or speculative, it's functional. That floor provides insulation against complete reversals in price. Meanwhile, the monetary premium on silver during periods of dislocation creates upside that can be both rapid and disorderly. Historical precedents reinforce this dynamic. In the 1970s, as inflation surged and trust in central monetary authorities deteriorated, silver didn't just follow gold. It outpaced it for stretches. Its gains were exaggerated by scarcity, by capital flow velocity, and by psychological urgency. Investors weren't just buying metal, they were shedding currencies, and silver offered a faster exit. This brings us to a more structural insight. The financial system is deeply reliant on liquidity and confidence. When that confidence falters, the instinctive behavior is to move to hard assets. But hard assets that can absorb capital efficiently are few. Real estate is illiquid. Gold is stable but heavily monitored. Cryptocurrencies are still speculative. Silver, by contrast, remains a kind of overlooked wild card, legacy store of value with a volatile temperament. And in environments where speed matters, volatility isn't a risk, it's a tool. We are now operating in a world where debt levels are historically extreme, policy tools are constrained, and political polarization makes long-term planning increasingly difficult. That increases the probability of sharp breaks, unexpected inflation spikes, currency devaluation, capital controls. In that context, the ability to rapidly pivot matters. Portfolios require optionality, not just in what they hold, but in how quickly those holdings can respond to changing expectations. Silver offers that optionality. It's an accelerant, so the rationale isn't romantic, it's practical. You're not betting on a metal. You're preparing for a reaction. You're allocating to something that doesn't need a headline to start moving. It responds to underlying currents. And when trust is evaporating and systems are recalibrating, the winners aren't the ones who saw it coming. They're the ones who had assets that moved the moment things changed. Silver does that, not always, not forever, but exactly when it needs to. The fundamental misunderstanding many investors have is believing that assets need to fit into rigid, singular categories. But the real world isn't structured that way. What works, especially over long periods and during transitional phases of economic regimes, are assets that can straddle domains. Silver is one of those rare assets. It's both an industrial commodity and a monetary instrument. And that dual nature isn't a contradiction. It's a feature that becomes incredibly powerful when the world starts to shift. In a purely monetary sense, silver has a pedigree that stretches back thousands of years. It has been money across civilizations not because of tradition, but because of functional utility. It was divisible, portable, scarce, and widely accepted. Those characteristics haven't gone away. What has changed is the monetary system built around fiat currencies that no longer require a backing. For decades, this model worked, until cracks began to emerge, debts piled up, inflation targets became more elastic. Confidence in purchasing power became tied to perception rather than intrinsic value. And during such phases, people begin to look for alternatives. Silver, as history shows, resurfaces in these moments, not just as a store of value, but as a release valve for uncertainty. But what separates silver from gold in these situations is its industrial demand. Unlike gold, which is almost entirely monetary and ornamental in nature, silver has utility that extends into essential sectors of the global economy. It's used in semiconductors, solar panels, electric vehicles, medical devices, and high-efficiency electronics. These aren't fringe applications. They represent the very core of where the global economy is heading: energy transformation, technological expansion, and healthcare modernization. This creates a constant underlying demand floor. Even in times when monetary demand is subdued, industrial demand continues. This mitigates downside volatility and reinforces the long-term strategic case. What's important to understand is how these two identities, monetary and industrial, interact, especially during times of stress. In normal market conditions, silver trades like a commodity. Its price responds to manufacturing cycles, supply constraints, and geopolitical disruptions. But when the financial system comes under pressure, whether through inflation shocks, loss of central bank credibility, or fiscal dominance, silver begins to behave more like money. It detaches from traditional industrial price anchors and starts responding to monetary flows, capital rotation, and currency debasement. This shift is not just theoretical. We've seen it repeatedly from the 1970s to the post-2008 era. What starts as a trickle of defensive positioning turns into a feedback loop where rising prices create momentum and momentum creates allocation shifts. This dual response function is extremely rare. Most assets are either tied to economic output or to capital preservation. Silver operates in both dimensions, and because it is finite in supply and largely mined as a byproduct of other metals, its production can't easily scale in response to rising demand. This creates conditions where price appreciation can be steep and nonlinear. That's not speculation, it's a rational response to market structure. In an environment where policy tools are being stretched, inflationary pressures are persistent, and trust in fiat systems is being questioned incrementally, not explosively, silver's unique position becomes even more valuable. It's not a pure hedge. It's not a pure commodity. It's something else. It adapts, it reflects, and it amplifies the pressures within the system. And when you're managing risk, not just chasing returns, that flexibility, that dual identity becomes indispensable. When trying to understand where an asset might go, you have to start by understanding the structural forces behind its supply and demand. Short-term price movements are often driven by sentiment, positioning, or liquidity, but long-term trajectories are grounded in fundamental imbalances. Silver is a perfect example of this. The market structure reveals a quiet but powerful story, one where chronic undersupply meets relentless and increasingly inelastic demand. That's not a temporary condition, it's a structural one, and it sets the stage for volatility, repricing, and potentially a major realignment of value. Silver supply is not elastic. Unlike other industrial commodities that can ramp up production in response to higher prices, silver doesn't work that way. Roughly 70% of the global silver supply comes as a byproduct of mining for other metals, like zinc, copper, and lead. That means supply isn't directly responsive to silver's own price dynamics. Even if silver doubles in price, it doesn't necessarily trigger a surge in production because the underlying mines are operating based on other metals' economics. The consequence of this is that supply growth is constrained, regardless of what demand does. That creates fragility. At the same time, demand is moving in a very different direction. Industrial demand for silver is hitting record highs and is projected to keep rising. One of the main drivers is the global shift toward renewable energy. Solar panel production, which uses silver as a critical conductive element, has exploded in the last 5 years. As nations continue transitioning away from fossil fuels and toward electrified infrastructure, silver becomes increasingly embedded in that shift. It's not optional, it's foundational, and that creates a floor in demand that is largely immune to economic cycles. Then add electric vehicles, 5G networks, medical applications, and water purification. Each of these sectors is growing independently, but all rely on silver in ways that aren't easy to substitute. These are sticky sources of demand. They don't go away during a recession. In fact, many of them are subsidized through government policy, meaning that even in downturns, demand stays elevated. That's an unusual setup, supply that can't respond quickly and demand that doesn't decline with the business cycle. And that's before accounting for the monetary side. In times of financial stress or currency devaluation, monetary demand for silver surges. Investors begin to reallocate into real assets, seeking safety from erosion in purchasing power. Unlike gold, which is often more expensive and slow-moving, silver provides a leveraged hedge, a cheaper way to position for fiat instability. That layer of investment demand doesn't appear gradually. It spikes when trust erodes, when inflation surprises, when deficits begin to matter. And when that happens, the same constrained supply base has to absorb a wave of new capital. That's when parabolic moves become possible. What this means is that we're already operating in a market with a deficit. Demand has outpaced supply for several years now, but the full effect of that deficit hasn't been priced in yet. inventories are being drawn down quietly. Above, ground stockpiles are declining. The official data is delayed and often incomplete, so many participants don't see the buildup until it becomes acute. But make no mistake, the pressure is there building underneath the surface. Eventually, something gives. Prices don't stay rational in the face of prolonged imbalance. Markets move in fits and starts, and when they do, they move hard. This isn't about timing the exact moment. It's about recognizing a setup where the odds are increasingly skewed. When you have persistent structural deficits and constrained supply pipelines, coupled with rising strategic demand, you're not looking at a stable equilibrium. You're looking at a powder keg waiting for a spark. The idea that something holds value simply because a government says it does is a relatively recent construct in the long arc of human economic history. For thousands of years, people exchanged goods and stored wealth using tangible items, things that were scarce, durable, divisible, and had intrinsic utility. Silver fit that bill in every way. It wasn't just a medium of exchange, it was money. And that distinction matters, especially when the legitimacy of fiat currency systems begins to waver. The contrast between silver and paper money isn't philosophical. It's structural, historical, and legal. And it has significant implications for how one protects wealth in uncertain times. Fiat currencies are essentially political instruments. Their value is based on trust that the issuing authority will manage supply responsibly, maintain purchasing power, and preserve institutional credibility. But when that trust erodes, the entire system becomes fragile. Historically, no fiat currency has endured indefinitely. Debasement, hyperinflation, or loss of faith has ended every purely paper-based currency system. The examples are many and recurring: Roman denarii, the Weimar mark, Zimbabwe dollars, Argentine pesos. Each of them began with confidence and ended in collapse, not because of external shocks, but because of internal mismanagement and unchecked monetary expansion. Silver, by contrast, doesn't require belief. It carries value by virtue of what it is, not who issues it. It can't be printed. It doesn't need a central authority. It isn't tied to a yield curve, a policy meeting, or a debt ceiling. It's a neutral asset, independent of sovereign control, which is precisely why it has retained monetary utility across empires, regions, and political systems. The legal frameworks that once backed silver as currency weren't what gave it value. They simply formalized what was already understood by the market. When those legal structures were removed, silver didn't vanish. It just shifted into private hands, waiting for the next time faith in fiat would falter. What's particularly striking is how governments have moved to distance their currencies from any tangible backing. Over time, the legal requirement to redeem paper notes in metal has disappeared. Today, the dollar, the euro, the yen, they are all liabilities of central banks, backed by debt instruments and policy credibility. This system allows for tremendous flexibility in managing economies, but it also opens the door to unchecked money creation, and that has real consequences. Once fiscal policy dominates monetary policy, once governments rely on central banks to fund deficits by expanding balance sheets, then the system enters a reflexive cycle. Trust begins to erode, inflation expectations rise, and the risk of currency debasement increases. That's where silver re-enters the picture, not as a speculative trade, but as a defense mechanism. It's not subject to legal gamesmanship or accounting gimmicks. It doesn't carry counterparty risk. Its value isn't a function of someone else's liability. When you hold physical silver, you hold a piece of history, a tangible link to a time when money was defined by its properties, not by decree. And as the credibility of fiat systems comes under pressure, whether through inflation, deficits, or social instability, people revert to what has worked before, not because they're nostalgic, but because they need something real, something they can trust without permission. Silver provides that bridge. It's legal tender in its own way, not because a law says so, but because the market continues to accept it when laws begin to fail. So the contrast isn't just historical, it's a living, breathing reality. Silver doesn't promise anything, it doesn't yield, it just exists, and that existence becomes increasingly valuable when everything else depends on trust that may not be warranted. That's the quiet strength of real money. It doesn't need to prove itself, it just waits. Markets are forward, looking, but they often carry the weight of inertia. They get stuck in narratives anchored to recent patterns, even when the underlying fundamentals are signaling something different. One of the clearest signals of mispricing in today's financial landscape is found in the gold-silver ratio. This ratio, which simply expresses how many ounces of silver it takes to buy 1 ounce of gold, has quietly drifted into historically extreme territory. And when that happens, it's often not gold that's overvalued. It's silver that's been left behind. To put this in perspective, the gold-silver ratio has averaged around 50 to 60 over the last century. That range reflects a long-term equilibrium based on monetary, industrial, and market dynamics. But in recent years, that ratio has stretched far beyond historical norms, hovering around 85 to 90, and at times even above 100. These levels are statistical outliers. They are not sustainable. They reflect temporary dislocations, usually driven by fear, liquidity preferences, or distortions in capital flows. And historically, such extremes have not lasted. They revert, and when they do, the adjustment tends to come through silver catching up. This isn't just about relative value, it's about behavioral patterns in capital markets. In times of uncertainty, capital initially flows into what's perceived as the safest hard asset, gold. It's bigger, more liquid, more institutionalized. But as fear gives way to strategy and investors begin to assess long-term positioning, they often look for undervalued proxies. That's when silver begins to outperform. It's not just a spillover effect. It's a reallocation based on price signals. The gold-silver ratio becomes a trigger for mean reversion trades, for speculative flows, and for hedging strategies that seek asymmetry. Now consider the backdrop. Both monetary and industrial demand for silver are rising. On the monetary side, concerns about inflation, debt sustainability, and currency depreciation have led to renewed interest in hard assets. Central banks continue to accumulate gold, while individual investors are increasing their exposure to physical metals. But silver, with its smaller market and greater volatility, often responds later, yet more dramatically. On the industrial side, the story is even more compelling. Solar energy, electric vehicles, advanced electronics. These are sectors that are growing rapidly, and they all rely on silver. This is not theoretical demand. It's real, consistent, and expanding. Despite this, the ratio remains elevated. That's the dislocation. It suggests that silver is still priced under conditions of stagnation or irrelevance, while the reality is that demand pressures are building, supply is constrained, and macro tailwinds are intensifying. That kind of divergence doesn't last. Eventually, capital catches on, And when it does, the velocity of the reversion can be sharp. It's important to remember that markets don't reward those who act when the consensus becomes obvious. They reward those who position before the adjustment. The gold-silver ratio is flashing a signal, a loud one. It's not just a technical metric. It's a window into how misaligned perceptions and pricing can become in the short term, even as fundamentals quietly build pressure. When those forces converge, silver doesn't just outperform at reprices, and the impact on portfolios, if positioned correctly, can be significant. So the question becomes simple. If history, fundamentals, and supply-demand dynamics all point in one direction, and the ratio confirms it, how long can this undervaluation persist before the market moves? The answer is rarely forever. It's usually until it doesn't. And when that moment arrives, silver tends to move not in increments, but in leaps. That's not speculation. That's how mispriced assets catch up. If paper money loses credibility, and history shows that it can, silver stands ready to reclaim its role, portable, valuable, universal. It's not a speculative toy. It's a disciplined position for financial resilience. So the question isn't, should I buy silver? It's how much silver should I hold now before the storm arrives? In the end, silver is the asset you hold not because you expect perfect performance, but because you expect the imperfect world to test the limits of paper credibility. Let silver be your bridge when paper fails.